Market to Market is everywhere you are. Subscribe to Market on YouTube, find us on the PBS video app to stream on demand, and add our 3 podcasts on your favorite podcasting app.
Welcome into the Friday, December 24, 2021 Market Plus. Joining us virtually, Elaine Cubb. And Elaine, over the years, you've been so kind to join us on this show right up against Christmas Eve. I think one year you drove, you took your microphone off, and I think you sang in the choir that night.
Yes, I drove 8 hours and made it to midnight mass, just scooped right in time, yes.
We're not cutting it that close this year. How about that?
No, this is great.
Okay, so we always appreciate that. I was not a very good host earlier when I cut you off about the hog market. I had 2 parts to an ASF question. One was about China, but there's another concern that there's maybe some more global travel going on, and we might just find a way to get a case from an island nation into the United States. Is there a big scenario playing somewhere in the doomsday side of this equation of what if? I mean, we've always talked about the what ifs with ASF, but is this becoming a reality or one of those we just need to stop it and move on?
Well, you know, I am about as comfortable speaking about this as I am about COVID variants, right? I'm not an epidemiologist, but there's some expectation, I think, in the hog industry that we have, you know, much better hygiene or, you know, sanitation practices industry-wide here in the United States. And I think some optimism that we might be able to handle it well, or to isolate individual production facilities better than some other countries, you know, notably China and their backyard hog herds. We might fare better than others, but gosh, it would still be bad. I mean, it would still have a huge reaction in the market because you'd be looking at a surge of pork availability, but then a later shortage of pork availability if the breeding herd got majorly cut.
You're not an epidemiologist, but how about a geopolitician? Let's talk.
Okay, yeah, sure.
Let's talk something else more. Paul in Minnesota, and he's asking if Russia invades Ukraine, what's that mean for the American farmer? Is this a repeat of the early 1980s on the horizon?
Okay, so this is a huge question, and you know, so part of it, sure, we look at it from the Russian grain prices perspective, that would be one scenario, but it doesn't even have to get that far. It is already affecting the American farmer because it is affecting natural gas prices, right? Russia export, or the EU and the UK import about 30% of their natural gas from Russia. And there is not only that pipeline that they're trying to get going, but there was another pipeline that had to shut down this past week because of cold weather. So all of a sudden you had record high natural gas prices in the EU and UK, and they went up another 20% just this past week. They're now 8 times higher than they were a year ago. And you think, well, what does that have to do with the American farmer? Fertilizer, right? The reason, in my analysis, the number one reason why nitrogen-based fertilizer prices are so high right now is because of the plants in Europe that have cut production, because it is just impossible to profitably create nitrogen-based fertilizer when natural gas prices are as high as they are. So natural gas prices stay this high, fertilizer prices worldwide stay this high for as long as there is all of this tension on the Ukraine and Russia border. And how long does that last? I don't know. Do you know? I mean, nobody knows. Vladimir maybe knows.
Well, there's the discussion about through the Olympics in February that they'll maybe play nice, and then maybe we'll see a China-Taiwan scenario. There's a lot of uncertainty going into 21. I'm going to flip just a little bit here. Let's stick on the input question, and let's go to, let's ask Chad in Nebraska's question. He has another question when it comes to inputs. He's saying anhydrous in that $1,400 range, he's saying it's got to come down, right?
Right. If this was just a U.S. story where we had, you know, some disruption from the hurricane, I would strongly suspect that prices, you know, don't stay inflated like this forever, that they would spike and come back lower. They are record high. Even dry urea, which is not as bad as that anhydrous price, but dry urea is like $900 a ton nationwide, sort of a retail average price. That's a record high. But here's the thing. Let's not panic about that. Sure, it's higher than it was a year ago, but 2020 prices were sort of low to begin with. And actually, when you compare this to 2012 sort of level prices, this is only about 13% higher than that. So it is a record high, but it's not unprecedented. It's not a level of prices that we've never been able to deal with before. It is adding to the cost of production, and we can talk about that a little more. But specifically to Chad's question of will they come back down? I think it really depends on European fertilizer prices. This all goes back to the natural gas thing and the Vladimir Putin thing. If global prices for fertilizer are so high, fertilizer, to keep it in these borders, we're going to have to match those global prices, and it could remain that high through spring. But I do think here's the thing that would really be the panic is if we didn't have the supply, if there wouldn't be the production availability for U.S. farmers, then we would really be panicking. And at this point, I don't think we should be. My understanding is that our domestic production industry will create enough for us to have it at least available in the spring. So fingers crossed that I'm guessing correctly there.
Which is different than some of the other things we've seen in the supply chain issue, whether it's chips. This is something that just is really expensive, but it's there.
Yes, that's my understanding, yeah.
All right, Phil in Dresden wants to know, it's a corn question here, Elaine. In retrospect, why are corn prices holding up as well as they have, despite a huge U.S. crop? December 22 corn at approximately $5.48. This is rare air for new crop corn. He's asking, do we contract some now or wait until June 18?
Yeah, so let me shoehorn in this cost of production thing again. So even with these higher fertilizer prices, higher herbicide prices, higher labor prices, higher fuel prices, higher machinery prices, higher everything prices, we have seen some of the university extension people come out with their 2022 crop budget expectations. So Nebraska, for instance, the University of Illinois, for instance, if you look at their numbers, you're talking about a cost of production for corn that could be $3.50, could be $4 per bushel, sort of depending on your irrigation costs in Nebraska or high land costs in Illinois. So what this is about 50 cents per bushel higher cost of production than it was a year ago. All we have to do is make at least 50 cents per bushel more than we did in the current marketing year. The good news is, as Phil points out, we do have those prices available. The new crop futures prices are, like you said, $5.50. A year ago at this time, you'd be looking at a new crop futures price that was only $4.20. So our opportunities to make profit, even at these higher input costs, the opportunities to make profit are there. So if you like making profit, yes, it's a good idea to lock in some of these prices. I am not suggesting anybody should not do that, but I also don't think it's that urgent. As I mentioned, in the main program, is that I feel these prices are pretty well supported. If you start to see something bearish happen with the weather in South America or something else to make these markets fall apart, don't let this profitability go away. Don't do nothing until next harvest. But just, recognize that and sleep soundly this Christmas that we're probably likely going to be able to make a profit of some kind.
All right, we've had enough bulls. Let's get to some bearish questions because we have a couple that are also things to consider. Ryan in Rapid City, South Dakota, for instance, Elaine. With the Federal Reserve looking to raise interest rates in 22 to combat inflation, is there enough upside in the commodity market to justify holding on to grain, or is selling before the rate hikes the better option?
Well, I don't know that the rate hikes would automatically knock commodity prices as much as they might knock everything. I think what you'd see is sort of an intermarket play or sort of a broad sell-off from the other assets, but a higher interest rate is really going to hit the stock market first, if it would hit anybody. And actually the stock market to that announcement was fairly calm. I think they saw it as a good sign that the Federal Reserve is going to do something about inflation. And inflation is the main problem that businesses are worried about right now. So the market and investors generally are looking at these rate hikes as a good or at least a stable sign. And I wouldn't worry that they would knock commodity prices entirely. It would remove some of that argument about an inflation hedge, but that's not what's underpinning these strong commodity prices. I think it's fundamental supply and demand that's actually underpinning the strong commodity prices, at least in the grains.
All right, we're going to ask one more question, and it's a little bit of a downward question. And this is from Ram in Edgar, Wisconsin. And this is a question where he says, with the trade long on funds and the farmer long on grain, how long before the markets make a major downturn?
Well, can I just punt and say weather in South America. The markets, I believe, are responding to fundamentals, and we do have, certainly until February or March, this will continue to be a weather market in that sense.
Well, okay, so maybe let me ask it a different way then. I haven't said the S word, the speculator word. I think it was Naomi who tweeted this week. It might have been Angie. It was one of those two that said something about, hey, are you complaining about the speculators now? Because they're the ones putting money into the market in their eyes. Do you agree?
Yeah, it's not. The participation of speculators has been notable in 2021. There's been a lot more sort of discretionary fund trading than we've seen in some recent years, but it's not a record high proportion. It's not an overwhelming force in the market the way that it was maybe in 2008. Actually, the majority of these grain futures markets is, and always has been, actual commercial bona fide hedger business.
Bona fide commercial hedger business. That's the title of this Market Plus episode.
Super.
Merry Christmas, Elaine Cub. Thank you so very much.
Merry Christmas to you, Paul.
All right. Next week, we are going to look back at the biggest stories that happened in rural America and impacted rural America in the year 2021. And Don Rose gets to close us out and analyze the markets. Thank you so very much for watching. Have a great week and a great holiday.